instability. The second reason for this is that what I've just described isn't quite right. Really and truly what's going on in the system is that banks create money. They create money by making advances, and with each advance they create a deposit, and that is the way money is created in our economy. And this tends to create extreme instability in the credit system. It leads to credit expansion during good times when there are seen to be very good opportunities for lending, which allows them to lend more, creating more money, which then tends to push up the prices of assets, therefore justifying the decision. That gives you the credit cycle. So that's the second reason why getting rid of government creation, moving to government creation of money might, it is argued, lead to a more stable private financial system. Then there's a completely different argument, which is very attractive to many people, which is that if government took back the power to create money from the private sector, it would have a cheaper way of funding itself. It wouldn't have to pay interest, or at least it would have to pay much less interest, because it would appropriate to itself, if you like, the liquidity services of money, get the value of that for itself, and it would lower the cost of borrowing for the government, essentially transferring this from the private sector. I'm not going to get into the very interesting theoretical question of where the seigniorage, which is really what we're talking about here, the benefit of creating money, which is created by the private sector, where it actually goes. I think it's essentially competed away, or it's largely competed away in the interests of borrowers, but that's not necessarily in the interests of the economy. But that's a controversial issue. Now, an important feature of what I've laid out as the reasons for doing this, I know I'm going on too long, I'll try and accelerate a bit, is that these ideas have historically appealed very, very strongly, and this is very rare, in fact almost unheard of, to the left and the right. This is not a left-wing or a right-wing issue. The right like it, and this is why perhaps the first articulate, fully specified proposals of this kind actually came from the Chicago School of Economics, of all places. You know, Milton Friedman's teachers, the teachers of Milton Friedman, including very famous American economists of the 30s, in response to the Great Depression. And they liked it because they thought, if we can get rid of fractional reserve banking, we'll have a more stable financial system, and then we won't have to regulate the financial system so much. The rest of the financial system, as it were, can be allowed to do what it likes because the banking and monetary systems are safe. So they liked it for that reason. And people on the left like it for that reason, but they also like it because it gives government disposal of a great deal of funds, which it can use for any purpose it sees fit. And that's very attractive to the left. So I'm not going to place positive money on this spectrum. I can leave that to them. But it's very interesting fact about these debates. So my ideas on positive money, which on fractional reserve banking, which appear in my book, will certainly appeal to some really libertarian economists like John Cochrane and Robert Lucas, who are very well-known figures from the Chicago School, and also, obviously, people on the left. So that's the first question. Why should we think about this at all? I've tried to set out what the issues are. So the second question is, how do we do it? And it seems to me there are, roughly speaking, two proposals out there, and since they're not, I believe, very different, the amount, I will specify them relatively simply. The first proposal usually goes under the name of 100% reserve banking, which would mean that all deposits, and you'd have to define exactly what a deposit is for this purpose, but certainly current non-interest bearing deposits, and one would probably want to go further, are fully backed by liabilities of the government. So matching liabilities of the government. Those could be liabilities of the central bank or of the state itself. It doesn't matter because the central bank is, of course, an organ of the state. It's not an independent part of the state, so I don't think this matters at all, whether it's cash, central bank bills, treasury bills, but there would have to be maturity matches, of course, so they would be relatively short term. And that was, of course, what would allow the government to finance itself at the short-term end of the yield curve, and possibly, and in a low inflation environment, essentially at zero interest rates, which would be clearly very attractive for the government. So if the government then paid people anything for people in the country for any purpose, they would deposit their check with their Bank of England check with the bank, and the bank would then owe a deposit to the depositor, and it would owe a claim on the central bank, and the claim on the central bank it would have to hold, or the claim on the government it would have to hold. It couldn't create advances, and in the process it couldn't create deposits. And the alternative proposal, which is positive money proposals, is that the banks are really just agents. They don't even have this degree of complexity of the balance sheet. They would just simply be employed by the state to manage the accounts, which are really in government money. So ultimately, you might think of people actually holding accounts at the Bank of England directly. And I don't think myself that the difference between these two is at all important, as I said. So those are two ways you might go about it. Most of the arguments have been about the former, not about the latter. So now let me move to my third and much most important questions. Why should anyone object to this transparently intelligent and sensible new way of running our monetary system, given, after all, that the alternative system has shown itself consistently over many, many centuries to be radically unstable, and the instability has not got smaller over time. It has got, if anything, bigger. There is an argument to be made that the last financial crisis was a crisis the worst we've ever seen, and the only way we've avoided its complete collapse was through an absolutely incredible amount of government insurance of the system. So what are the objections? The first objection was exactly the objection that was made by Mr. Iza. Have I got your name correctly? Itza, I apologize. Which is, it's going to lead to hyperinflation. Nobody can trust a government with this amount of power. If it is entitled to print money freely, it creates all the money in the system. Politicians, being politicians, are bound to abuse their privilege, and sooner or later we will be in 1923 Weimar Republic or Mugabe's Zimbabwe of today. And that point was actually made in by one of the people, Philip Booth from the IEA, in response to my column on this subject. There are answers to this objection, and they're discussed by Positive Money and others, and I'm going to just repeat them very quickly. The first is you could, and indeed I would argue you should, leave the decision on how much money to create to an autonomous institution. Let's call it for the moment a central bank. So it wouldn't be left to the finance ministry to decide how much money should be created. That would be, as now, left to the central bank. It's just that it will be done in a different way. Obviously, it's a different mechanism. And the second argument against it is, well, it's actually not that different from what we have now. True, the government would get the benefit of money creation in a direct way, but the government, of course, is vitally interested in monetary policy today, because even if it doesn't get the money directly, it's very interested in what it's used for. It loves house price booms, for example. So it would like the central bank to create house price booms, and indeed it welcomed them until it blew up. So in essence, the temptation for the government to abuse the privilege under the assumption that the central bank continues to control the process wouldn't be, one could argue, fundamentally different from the temptation to abuse the process that it has now. And it's precisely because of that temptation to abuse the process that we've tended to move in most countries, really to a remarkable degree, to at least quasi-independent central banks. And if we have that, then why should we worry about this potential for abuse? And after all, finally, we can remember a time when it was taken for granted the Chancellor would manipulate interest rates for purely political reasons. and the system that we are now discussing, one in which the central bank made money, which will be used to fund the government, would clearly be better. By the way, using it to fund the government is not the only way one could do it. I don't have the time to alternate. You could imagine a situation in which we would agree that it wouldn't fund the government directly, but the money creation process would simply be, the money being created by the central bank would simply be sent in equal proportions to every individual in the country. You could imagine that. I can imagine many variants on this. You could imagine in theory that it wouldn't go to the government at all. But of course, all these are political decisions. Goes without saying. They're quasi-political decisions. I'm not suggesting that that would get you out of politics. The second set of objections, I'm really doing badly here, but it will be over in 10 minutes, I think. And these are very important. The second, these are really important ones. This is, I think, the most important. I've spent a lot of time discussing the points I'm now going over with Adair Turner over the summer, because he's completing his book after I completed mine. So it's been very helpful and clarified it. So the second set of questions is that the borderline between banking and non-banking, or between the monetary system and the financial system, cannot be policed. It is impossible to police it. Now here, this is very, very important. This does not affect those arguments which relate to the desire to fund the government more cheaply. They do relate fundamentally to the desire to make the financial system more stable. Clearly, if it were not possible to police, i.e. the private sector would go ahead and find some way to create near monies, quasi-monies, and the private sector has consistently been able to create near monies and quasi-monies through the centuries, and you couldn't police it, then you would actually, the central bank would have to get involved in all that. So in addition to this, you'd have a central bank managing that in some way, and it would be more or less the same problem as we have now, except we would have this separate monetary system funding the government. And of course, the rates of interest that the central bank would try to create in the rest of the monetary system, and it would have to have some reserves to do that, will be much higher than otherwise, because you'll be trying to prevent it from growing as much. In the past, I used to take the position personally that 100% reserve banking or a close relative could not possibly work because banking would reappear outside the banking sector. And this must be true, at least to some extent, and consider shadow banking today. I mean, that's exactly what happened. When, for example, money market mutual funds were created, because that was essentially a way of eliminating the need for capital, equity capital, in banks that offer deposits. That was it was essentially, it turned out in the crisis, money market funds were banks with much more shorter term assets, but some of the risks. There is a counter argument, however. First, or counter arguments, if we cannot police the borderline between banking and non-banking, the entire new regulatory structure we're in the process of creating busily after the crisis is going to fail, because a lot of it is built around the assumption that we can do just that we can police banks, impose high capital requirements, make them safer, all of which is certain to increase the incentive to create shadow banking in various forms. And if you can't police that periphery successfully, our current reforms are going to fail. So it's essentially an argument against all systems that attempt to make part of the system relatively safe, which is a perfectly valid libertarian Austrian argument, but it's not the argument, but it's not an argument that our officials can use, because it's not the argument they're making. The second point I would make is that while one certainly can't eliminate it, if you have a credibly safe banking system, which clearly provides the payment system and liquidity on a large scale to people who really need it in an efficient way, then it seems to me there are ways of controlling the growth